All right, let's dive right into this explainer and demystify a high-stakes fixed-income concept that affects, well, absolutely everyone. Honestly, whether you're just an everyday saver putting away some cash into a fixed deposit or a global pension fund manager responsible for billions of dollars, this one concept heavily dictates the reality of your returns. Today, we are talking about navigating reinvestment risk. But hey, before we get bogged down in formulas and all that heavy financial jargon, let's start with a very simple, relatable question. What on earth does a mango tree have to do with your savings? Picture this. You own this incredible, magnificent mango tree, right? And it produces a huge batch of fruit for you every single year. You harvest that fruit, you sell it, and naturally, you take your profits to reinvest into expanding your agricultural business. But what happens if, next year, the business environment is just terrible? You've got all this cash in your hand from your mango sales, but you can only invest it into poorly performing fields. Even though your original tree is doing perfectly fine, your overall future income drops because your new investments just aren't yielding those same results. Well, that, my friends, is exactly the core mechanism of reinvestment risk.
Here's exactly what we're going to cover in this explainer today. First, the mango tree analogy. Second, what is reinvestment risk? Third, the real-world financial impact. Fourth, the highest risk investments. Fifth, the classic bond trade-off. And finally, strategies to actually protect yourself.
Section 1. What is reinvestment risk? Let's get into the core mechanics.
So, formally speaking, reinvestment risk is basically the possibility that your future cash flows from an investment, things like periodic coupon payments from bonds, principal repayments, or even stock dividends, will have to be reinvested at a lower interest rate than what your original investment was yielding. Think about it. When you buy a bond yielding 8%, you're naturally assuming you can take every single cash payout and put it right back to work at that exact same 8%. But if you can't find equally attractive opportunities for that cash, your expected return is going to be severely compromised. Now, there's this really fascinating seesaw effect in fixed income, and it's a super tricky dynamic. When interest rates in the broader economy fall, the market price of the bonds you already own actually goes up. And hey, that looks great on paper. But here is the massive catch. As those rates fall, your reinvestment risk simultaneously shoots up. The market is actively punishing your future compounding potential purely because any new cash you receive must now be put to work in a weaker, low-interest rate environment. Okay, don't let the math here scare you away. It's actually super straightforward. We can see this clearly in the mathematical intuition. The future value equals your cash flow times 1 plus the rate to the power of n. That r right there in the middle is your absolutely crucial variable. It represents your reinvestment rate. If you buy a bond promising a 10% yield, but that r drops to 5% by the time you get your first coupon payout, your final accumulated value physically shrinks. Your realized return is literally going to fall short of your expectations. Section 2. Real-world financial impact. Let's look at the financial devastation. Let's bring this into the real world with a retail scenario from India back in 2023. Imagine an investor puts 10 lakh rupees into a fixed deposit earning a fantastic 8%, expecting 80,000 rupees in annual income. Sounds great, right? But after just 1 year, the FD matured and interest rates in the broader economy had dropped significantly. New FDs were only offering 6%. So that investor was forced to reinvest at that new, lower rate. Their annual income instantly dropped to 60,000 rupees. That is a massive 20,000 rupees loss in expected income every single year, effectively killing their long-term compounding strategy. And this absolutely isn't just a retail banking issue. It happens aggressively in the corporate bond market too. Just look at the U.S. Federal Reserve rate cuts during the 2020 pandemic. The Fed slashed rates close to zero to stimulate the economy. Investors who were holding older corporate bonds, happily expecting beautiful 6% coupons, were suddenly receiving their cash in an environment where new investments were yielding a brutal 1.5%. Just imagine expecting your money to compound at 6%, but having to settle for a quarter of that. Your portfolio growth essentially slows to an absolute crawl. This brilliantly shows us that it's not just you and me suffering here. Massive institutions face extreme funding pressure from this. Huge insurance companies and pension funds in places like Japan and Germany suffered immensely during prolonged periods of ultra-low interest rates. And why is that? Because they depend heavily on predictable interest income to pay out their future liabilities, like retirees' monthly checks. When rates fall, their investment returns steeply decline, but their future liabilities, those remain completely unchanged. It creates a massive, terrifying structural gap in their funding.
Section 3. The highest risk investments. Let's name the portfolio culprits.
Look, not all investments are created equal when it comes to this danger. You can actually treat this like a little cheat sheet to evaluate your own exposure. Up at the top, zero coupon bonds have very low reinvestment risk. Moving down, standard coupon bonds are moderate and high coupon bonds are high risk, simply because you're receiving large, constant cash flows that you constantly have to find a home for. But look down at the bottom. Callable bonds and mortgage-backed securities. Those carry very high to extremely high risk. Let's look at exactly why that is.
These right here are hands down the worst offenders in the fixed income world regarding this specific risk. Callable bonds and mortgage-backed securities have extreme risk because their cash flows are directly and negatively tied to falling rates. Think about it. When rates drop, what do smart companies like Apple or Microsoft do? They refinance their debt cheaply. And what do everyday homeowners do? They refinance their mortgages, meaning they pay back their old, high-interest loans early. So as an investor, you get your original principal forcefully handed back to you at the exact moment you don't want it, right when the market is only offering terrible, low yields.
Section 4. The classic bond trade-off, resolving the confusion.
The absolutely crucial point to grasp here is clearly drawing a line between two major risks. On one side, we have interest rate risk. This is the risk that your bond's actual price changes due to market rate movements, and this price risk is highest in long-duration bonds. But on the other side, we have reinvestment risk, the risk that your cash flows must be put to work at lower rates. This cash flow risk is highest in short-duration or high-coupon bonds. It's a critical perspective to keep in mind because it's a classic trade-off. By trying to avoid one, you almost always expose yourself to the other.
Section 5. Strategies to protect yourself. Let's cover some defensive tactics.
So how do we actually defend our hard-earned returns from all of this? Well, first up is bond laddering. This means intentionally investing across multiple maturities, like 1, 3, 5, and 10-year timelines. Bringing it back to our mango tree, it's like planting different trees that are guaranteed to fruit at completely different times of the year. It brilliantly spreads out your reinvestment timing so you aren't forced to reinvest your entire portfolio during a low-rate valley. Second, you can use zero coupon bonds. Because they pay no periodic coupons, there's literally nothing to reinvest until the very end, effectively neutralizing the exposure. And third, for the big institutional players, duration matching allows them to immunize their portfolios by perfectly aligning the duration of their assets with their liabilities.
Well, we've covered the mechanics, the brutal math, and some really solid defensive strategies today. So I want to end this explainer with one final, pretty provocative thought. Are your future cash flows actually safe? I highly encourage you to look closely at your own portfolio today. Evaluate your yield stability. Look at your long-term income predictability. Because as we've clearly seen, securing a high yield today doesn't mean much of anything at all if you can't seamlessly reinvest it at a high yield tomorrow.